70%, I'll ask you this, up to 70% of all returns, depending on a study, are wasted by amateur public due to excessive trading. As well as the emotional response to greed and fear, people routinely overestimate their capacity to predict the markets and historically made erroneous, dreadful decisions. Talk about that.
Well, I mean, there's enormous amount of evidence that your average investor is very poor at making investment decisions. And there's two things worth highlighting about that. One is that people typically are overconfident in their ability to time the market. So they will try and buy and sell on the basis of their best guesses about whether the market's going to go up or down. It very rarely works for a retail investor to do that. Buy and hold is usually a much better strategy than timing the market. The second is, though, that people typically carry risk that they don't need to carry. Portfolio theory is not perfect, but one of the things it does is it gives us a basis on which we can eliminate much of the risk that's not of an asset that's not correlated with market risk by having an appropriately hedged portfolio. A colleague of mine, Jeanette Rutherford's done some really interesting research looking at investment decisions made by Victorian investors. She's got data on their portfolios from probate records when people die. And she's compared those investment portfolios with investment portfolios of modern investors. And one of the really interesting questions is, are people better or have people got better at diversifying their portfolios post Markowitz's portfolio theory? The answer is no. It turns out, actually, if anything, the Victorians were a little bit better at investing in a diversified way. So people are typically very unsophisticated about hedging risk in their investments. By the way, that often turns out to be the case with retail traders, that whereas it's very unusual for a professional trader not to be thinking in terms of effective hedging of the risks that they're taking, a lot of retail traders are trading in various kinds of unhedged ways.
Why do you think, if the failure rate's so high, that so many people are attracted to trading?
For me, actually, it's probably the same answer as why do so many people buy lottery tickets? Because actually the failure rate in lotteries is even higher. You know, the chances, I think my favourite quote about the lottery is that you have more chances of being kicked to death by a cow than winning the lottery. I think that's one of the statistics that's trotted out every now and again. And it's not quite as bad as that in trading, but actually, you know, the majority of people who work on trying to time the market as retail investors will lose money. And some of them will run out of their initial investment very quickly indeed. But why do people buy lottery tickets? They're not buying the chance of winning. What they're doing is they're buying a dream. You've bought that lottery ticket, and what it is it's a ticket to imagining, what will I do with all that money if I win? And I think many people trade for the same kinds of reasons. They're buying a dream.